After a busy and remarkable week in geopolitics, in energy policy, we're back again with another episode of Energy Shots. Kevin, it's so great to be here with you.
Great to see you, Joseph.
So I have to say, we're recording on Thursday morning. We will broadcast at our usual Friday time slot.
We will.
So caveat emptor, if anything happens in this dynamic week between now and then.
Well, you bring that up. That's a great place to start because I have a gift for our viewing audience.
And what is that?
Well, it's a neologism, a new word created to help explain why we need that caveat before we start this episode. It's called InFOMO,
Yes.
which is like regular FOMO, but for informational fear of missing out. And in this time that you just described, there's a lot moving very fast, so quickly that 24 hours might be an entirely different world, entirely different market. And so it's InFOMO. It might also be InFOMO, which is that there's so much information going on that it's flooding the zone. Either way, there's your word for where we are.
Well, and this is, this week was such a fascinating thing to watch because you had the president taking a very aggressive stance on Greenland. We have continued consideration of military action against Iran as the protests there continue pretty steadily and unabated. And then you had the World Economic Forum, and I have to say this is one time where a trip to Davos actually looked pretty appealing to me, given all that was happening with the speeches, the statecraft. What are two or three things that you've watched this week?
It's amazing how that can crowd out some of the other things that are still going on, including negotiations mediated by the U.S. between Ukraine and Russia, and the possibility of sanctions here in the U.S. if they don't go well against Russia, and also structural change to how oil sales, contracts, production are coming out of Venezuela, which is still very meaningful and important.
Of course, this week we saw some of the first deliveries of this sort of U.S. custodial sales of oil coming out of Venezuela. So we have the ongoing storylines and all of these new ones. But I think today what we want to talk about is a little bit of a look back. We're 1 year now into the Trump administration.
Right.
Dramatic changes in U.S. energy policy, U.S. climate policy, and U.S. approach to multilateral problems writ large.
Well, I think the focal point, really, if we look back at the last year, was the president's deployment of his signature policy. You know, another thing that's going on is that everybody keeps waiting for the Supreme Court to rule on the International Emergency Economic Powers Act case to figure out whether the president's tariff-setting powers, which he displayed very ably with regard to Greenland just a few days ago, will be legal and what they might be replaced with. So maybe a focal point that is a good starting point for this conversation would be Liberation Day.
Let's talk about it.
April 2nd, 2025. The president deploys his reciprocal and global tariffs, and markets crash. And so if you look back from that as base 100 being the day, April 1st, crude markets, the S&P closed, and look at what happened. You have a divergence. And a divergence that happens to map directly to what the president said he wanted to do. He wanted lower energy prices, and he wanted more American prosperity. Of course, there's a lot of ways to measure prosperity besides the S&P 500, but using it as a marker, up as of yesterday's close on the 21st, 22 points since that base 100 on April 1st of 2025. And crude down a little bit more than 12 points, and actually down a little bit more even today as we're doing this broadcast, recording it ahead of Friday's release. And so what do you have? You have lower energy prices globally, and also a stock market that seems to have improved. How does that look to you?
I mean, if you were to look at the statements of leading economists, by estimation, the tariffs that the president released on Liberation Day are the second largest unilateral tax increase on the American population ever, right? And I don't know that you would have thought that you'd see such durability in the S&P 500 over the course of the year, even though tariffs got traded away in various trade deals. This is a significant change in U.S. tax and fiscal policy, and markets seem kind of durable. And at the same time, the president has continued to say we want low oil prices, and prices have gone down.
A lot of that credited to OPEC plus adding back headline barrels to the global supply when markets were already long, and also maybe some demand weakness, which may be coincidental to the tariffs that you mentioned, but maybe not.
We're all vulnerable to type 2 errors in making attribution. And so one of the things I think we can look at, and one of the things I looked at for this week, is the share, what happened with manufacturing, employment, and output. Much of the tariff storyline is about the U.S. using more aggressive tools in international negotiations. But a lot of it is also about restoring manufacturing jobs as a key component of domestic well-being, right? That the administration thinks that manufacturing jobs are the ones that should support families. They make the U.S. stronger. The more we make it home, the more secure our economy is to all sorts of international vulnerabilities or malfeasance. And so the question is, are the tariffs working to change manufacturing output? So we pulled data from the Fed and from BLS, and what we see here is first blue. This is manufacturing employment, and we have a very non-zero start to the chart. This is thousands of jobs. And you see like a bit of a trend downward in manufacturing employment. This is about a 0.3% drop over the course of the year. So it's not a catastrophe, but you do see a little bit of a fall off. By contrast, we have in the green bars here the manufacturing index. It's set to 2017 for normative reasons. And while it fell a little bit in the first part of 2025, over the course of the year, we saw quite a bit of stability, and now you actually see rising productivity, much of that being in base metals and aircraft.
Is that seasonally adjusted?
I did not seasonally adjust this one. We'll get to seasonal adjustment in a minute. But what the storyline you might talk yourself into toward the end of the year, there's been some productivity increases in manufacturing. That might not be bad for the administration's agenda. Much of what they're trying to achieve are not just numbers of jobs, but good jobs. And it'll be interesting to see. This is such an experiment in economic policy. It'll be interesting to see what the next year brings.
It's an experiment in politics too. I mean, as a matter of economics, I think most people who run businesses would rather have lower labor intensities of production. And as a matter of politics, most people who run campaigns would rather create jobs.
Right.
And so economics always wins in the long run. But in politics, as I think we've said on this show before, there is no long run.
And the other major thing to think about in this context is, what does this mean for energy? So here we have actually seasonally adjusted electricity consumption for the industrial sector here in the U.S. We don't have the new enough data to look at 2025 in terms of all energy consumption for manufacturing. Hopefully our friends at the EIA can speed that process up as part of their modernization. We've got Liberation Day denoted here, and not much to annual signal, actually. This is kind of, once you seasonally adjust, because there's a lot of electricity consumption in the summertime, you don't see a lot of change in 25 into 26. And compared to previous years, this is about a 2% year-over-year increase in every month. And so we see, again, like a little bit more manufacturing activity in terms of electricity consumption. Maybe some electrification of facilities is occurring here, but no major changes. The reason why this is, of course, interesting is we are also now manufacturing intelligence in large data centers. And so how much that new demand signal is changing electricity prices is not just a big source of concern for politicians facing a mid-year or a midterm election, but is a question for the broader economic agenda of reshoring manufacturing.
Secretary of Interior Doug Burgum, also the chair of the National Energy Dominance Council, is fond of using the words intelligence factory instead of the words data center, because he wants to get to that manufacturing of intelligence, which he mentions is also is a non-specific good that can be an input to all industries as a precursor to all economic propositions.
Base metals, tokens, whatever you need, the U.S. can make it.
Including research.
And, Kevin, fossil fuels.
And fossil fuels. Well, this is where things get interesting. So the proposition that the president put out there for lower energy prices has a bit of a headwind for investment in energy. One of the things that people who sell energy like is higher prices, which again goes back to that politics economics dichotomy. And what we have here is an adjusted investment for upstream oil development based on the cost index using a 2000 base. And so this gives you a sense of sort of what real investment looks like. And then you can see the new output that happens within a year of that investment.
Can I briefly pause for interpretation? So this cost index is like, equipment, pipes, labor might have been cheaper in one year or another, and this gives us a way to sort of estimate that.
Right, to think about
over
investment
time.
in common size terms rather than looking at a nominal number that may reflect significant cost increases.
Understood.
This is a way of netting out that cost factor.
Got it.
Leaving aside what the actual numbers would be on the y-axis,
Right.
what we have is something that's consistent across the expanse of time. And so it gives us a way to look at what oil output did based on that sort of real-ish investment.
Understood.
And what it does is it correlates really closely, right? So it's about a 0.6 R squared to 0.8 positive correlation, which, by the way, if you square it, comes to 0.64. So there's your 0.6. Math is fun. And what do you get? Well, you get this notion that if you have lower prices, you probably get less investment.
Right.
If you have higher prices, you get more investment. When you have more investment, you get more oil, and then you get lower prices. Seems like there's a bit of a cycle.
The cure for high prices is
High prices? Apparently. Dr. Market says that.
And yet, what the administration wants to see, what the American voter may want to see, is low prices and higher output. What's the story there?
Well, so we could say that generally speaking, supply curves slope upward, and those two goals can be relatively difficult to manage in parallel.
Yeah.
But on the other hand, there's a different story we talked about a couple episodes ago about eliminating regulatory burdens and trying to bring down the costs for production so that you'll get more output at a lower market price.
Right.
But there are some basics about how the world works. And I think this is a good time to have a conversation about that because we did mention that Venezuelan oil and the idea of adding supply to a long market. There are some relationships you can count on. And I mean, this relationship we have is one that I count on. And I very much look forward to our episodes every 2 weeks, just as we, by the way, look forward to your comments online. Please keep them coming. We love them. We enjoy them, even the salty ones. So the stockpiles globally, the OECD crude commercial stockpiles, inversely correlate very closely with nominal oil prices,
Yes.
which should not come as a surprise. This is one of those intuitive relationships.
Yep.
And that's what you see here. A trailing 12-month average nominal spot price of Brent crude is the blue line, and the OECD commercial crude stockpiles is the green line. And when one goes up, the other goes down,
So
and vice versa.
This is the COVID year. We see, a big drop off in consumption, lots of stockpiling, big fall off in price.
Yeah, so picking this time interval really illustrates the dynamics.
Yeah, right.
I think in a way that brings it home to anybody who had any questions.
It's a beautiful chart.
It's not the only relationship, but it's one of the ones that's so strong, it's really hard to miss. And when
Right.
you have supply so far ahead of demand, inventories build, the logical conclusion would be all other things being equal, prices are likely to fall.
And should one project the two lines on this screen to sort of expect a harmonic pattern here, where again the blue and the green will cross, and you'll see prices continue to decrease as stockpiles continue to rise?
Well, it's a question, and it depends on other things. Maybe we should go to the next slide and talk about some of those other things.
Yes.
This is a relationship that's a little bit less tight. So not as tight as our relationship, Joseph.
Right.
And what we have here is what we like to think of at Clearview as the capacity utilization of the production system for oil, which is not just supply coming out, but also the spare capacity available. And how much of that capacity is being used by consumption.
Not just how much is being produced, but how much could be produced in an emergency, or if OPEC Plus decided to open the
If
taps.
OPEC Plus
or-
decided to open the taps.
Understood.
Exactly. And so the blue line is still the very same average trailing 12-month nominal Brent price. And you can see it moving up and down just as it did on the last chart because it's the same line. The green line in this case, though, is that production system capacity utilization metric that we've created. And it tracks pretty closely. You can see that sometimes it over and undershoots, and there are some collinearities that are built in. If consumption it turns out to fall down, then maybe OPEC adjusts supply and spare capacity goes up. But generally speaking, these two move together too, which is to say you cannot think about the crude market without thinking about OPEC Plus. You cannot think about supply and demand without thinking about the out-of-market effects that can come from OPEC Plus and also from government strategic stockpiles, a conversation we have very frequently. The reason we talk so much about OPEC Plus, the reason we talk so much about the SPR and other strategic reserves in the world is because they are out-of-market effects that can change supply-demand balances. But this, I think, brings us to the next slide and sort of the next discussion, which is how do you really think about what adding supply to the market does to price?
And I asked you specifically to talk about this because the big question surrounding the resumption of Venezuelan oil production, exports into the market, the president's desire to see that help push oil prices down to 50 or below. What does the data actually tell us about that?
Well, there's a lot of ways to get an answer. I remember the days back when I was a sell-side research analyst. I was at an event with another sell-side research analyst, very competitive context. And as you might imagine, we were talking about our oil price models because we were essentially peering together, saying the same things. He said he had 300 independent variables in his model. I was like, well, that's a lot of independent variables. I only have like 20. I'm not sure all of them were equally explanatory, and he obviously had to do a lot of work to come up with projections of 300 independent variables.
Right.
But the point is, you can come up with very complex models of the oil market and get a pretty good number that's true until it's not. Or you can come up with back-of-the-envelope models.
Right.
And we tend to prefer back-of-the-envelope models because they're easy. And one way to do that is to work backwards from the price elasticity of demand.
Yes.
And to look at an observed price elasticity of demand. We have two endpoints we use, one for the market as it was before and now as it is now. So this sort of embeds a lot of assumptions about the market having those two endpoints, and then looking at what it means if you add supply using a price elasticity of demand equation. And that gives us this incredibly linear, incredibly static back-of-the-envelope chart. And what it shows is that if you add 1 million barrels, you get about $7.25 per barrel.
Okay.
And if you subtract them, you lose about $7.25.
And what gives us
per
this
barrel.
bow tie shape? Is this uncertainty? Is this sort of randomness? Like what is 2 to 8?
So yeah, the difference here is that the low end of the range reflects the price elasticity of demand as observed at a time when the market was least responsive. And this is the more responsive market of yesteryear. And somewhere between those two is probably the truth.
Right.
And so that's where you get the range. Now, this does not account for the out-of-market interventions that I mentioned, like government strategic stockpiles or OPEC+. It also doesn't account for the recursive responsiveness of supply to demand, which you would embed into any dynamic modeling exercise. This is a ballpark back-of-the-envelope estimate. But what it tells you is that if you get that extra 1 million barrels per day, all other things being equal, nothing else changed, you would knock a $7 barrel or so at the upper end of the range off the crude price, which might be a less than satisfactory reward for companies considering very significant upstream investment.
Right. And that sort of demonstrates the sort of like the economic concerns we heard from executives at the White House about the big reentry into Venezuela immediately.
Yeah, but of course you have to think about the bigger picture.
Yeah.
Will demand grow? Is this static analysis meaningful in that context? This is just a good way to think about any sort of price movement at a given point in time. And it's also important to remember that both sides of this bow tie matter because we're still talking about, as you mentioned, Iran risk. The USS Abraham Lincoln Carrier Strike Group on its way to the CENTCOM area of responsibility and questions about what could happen there. Maybe we'll be discussing that next episode.
I think we very well might. Kevin, such a pleasure to be with you today. Colleagues joining us online, thank you very much. We hope you have an energetic day. And Kevin, we'll see you on the next one.
All right.